Hello and welcome to The Explainer. Today we're tackling a really fundamental question for any business that holds stock. What are the goods in your warehouse actually worth? You might think it's just what you paid for them, but it's not that simple. And the accounting rule behind it? It's actually pretty brilliant. So just picture a warehouse, right? It's full of stuff. The company knows exactly what they paid for every single item. But is that its real value today? I mean, what if prices for those goods have dropped everywhere? Or what if some of the boxes got a little banged up? That's the core problem we're going to unpack. To handle all this uncertainty, accounting has a very smart, very conservative principle. It's basically a safety rule designed to make sure a company never gets ahead of itself and overstates its own value. Let's dig in. And here is the big rule straight out of the accounting standards. It's called the lower of cost or net realizable value principle, or LCNRV for short. It's the bedrock of how we value inventory. All it does is force companies to look at two numbers, what they paid and what they could sell it for today. And always report the lower, more cautious number. This visual just makes it crystal clear. On one side, you've got cost. Simple. That's what the company paid. On the other side, you have net realizable value, or NRV. You can just think of this as the product's realistic market price today, after you subtract any cost to get it sold. The rule is dead simple. You always have to pick the lower of the two. It's all about being prudent and not fooling yourself or investors about the true value of your assets. Okay, so now that we've got the main rule down, let's look at a really interesting little twist. What happens when we're not talking about finished goods on a shelf, but the raw materials used to make them? The logic here is pretty cool. Check out these two scenarios. On the left, if the final product you're making is still going to sell for a profit, you don't write down the value of your raw materials, not even if the price of those materials has dropped. The thinking is, hey, that final sale is profitable, so it'll cover the original cost of the materials just fine. But look to the right. If that finished product is going to be sold at a loss, well, then you have to recognize that loss early, and it starts by writing down the value of the raw materials themselves. And here's a perfect example to make that stick. A company bought raw materials for 40 lakh rupees. Today, if they had to buy those same materials, it would only cost 30 lakh. Now, because they already know the final product made from this stuff will be a loss maker, they have to face the music now. They can't keep valuing those materials at the 40 lakh they paid. They have to write them down to the current lower replacement cost of 30 lakh. So we keep using this term net realizable value. It sounds a bit technical, but how do you actually calculate it? Let's get practical and give you a simple toolkit for figuring it out. Don't worry, calculating NRV is really just a simple 4-step process. First, you start with what you think you can sell the item for. Step 2, you subtract any discounts you'd have to give. Step 3 is super important for goods that aren't perfect. You have to subtract any money you need to spend to finish or repair the item. And finally, step 4, subtract any cost to actually make the sale happen, like a sales commission. Whatever is left over, that's your true net realizable value. All right, theory's great, but let's put these steps into practice with a real-world scenario. We're going to take a case of some damaged goods and walk through the calculation together. This will make it all click. Okay, here's our starting point. Imagine a company has a bunch of envelopes in their inventory. The original cost on their books for each pack is 50 rupees. Easy enough, right? But then, there's a water leak. Now, to make these envelopes sellable again, the company has to spend an extra 15 rupees per pack just to fix them up. This right here, this is our cost of completion from step 3. And here's the final piece of the puzzle. Even after they spend the money on repairs, They know they can't sell them for the original price. The best they can hope to get for these repaired envelopes is 40 rupees a pack, and that is our estimated selling price. So let's put all the pieces together. The original cost was 50. It's going to cost 15 to fix them, and they'll only sell for 40. Given all that, what is the correct value that should be on the company's financial statements? This slide lays it all out perfectly. The original cost, we know, was 50 rupees. But the net realizable value? Well, that's the 40 rupees they can sell it for minus the 15 rupees they have to spend on repairs. That equals just 25 rupees. Now we just apply our main rule, lower of cost or NRV. Well, 25 is definitely lower than 50, so the envelopes have to be valued at only 25 rupees each. That's a huge write-down. Okay, to wrap all this up, there are just a few final rules of the road that make sure this whole principle is applied consistently and fairly by everyone. So there are three really critical things to remember here. First, you have to do this assessment on an item-by-item basis. You can't group a bunch of bad inventory with a profitable item to hide the losses. Second, this is not a set-it-and-forget-it calculation. You have to reevaluate the NRV every single time you do your financial reporting. And finally, and this is really cool, the rule is flexible. If the market gets better, a write-down you made in the past can actually be reversed. This timeline shows exactly how that works. In period 1, maybe the market price for your product falls, so you have to write down the inventory's value. But that's not necessarily forever. In period 2, if the market bounces back, you can write that value back up. The only catch is you can never go higher than what you originally paid for it in the first place. It's a valuation that kind of breathes with the market. And that really brings us to our final thought here. At the end of the day, the entire reason for this lower of cost or NRV rule is to make sure a company's financial statements show what's happening in the real world today, not just some wishful thinking based on old prices. So the next time you look at a balance sheet, you can ask yourself, is that inventory value reflecting today's reality, or is it stuck in the past?